Hello and welcome everybody. Let me get a little bit more light in. Hello everyone. It's a pleasure to be back here with you all today for another Sectors Made Simple webinar. Unfortunately, the market conditions aren't as optimistic as we've had in last year, and the market conditions have been deteriorating throughout the year. Today, we dipped below that 20% line for just a moment, but what it did was it signaled the beginning of a bear market. If that line continues to be crossed and we don't just sit there and mess with the line for a little bit, we will enter a bear market. So part of being in a bear market isn't panicking. It's not panic selling, but it's understanding how we need to shift our investments and understanding what options we have for investing in that market. We don't choose the market that we invest in, we only choose how we invest in the market. So today, I want to share with you 3 ways that we can invest in a bear market and the benefits and drawbacks of each, as well as the last one we'll talk about today leads into something awesome that we've been working on here at Sectors Made Simple. So, let's get straight into the action. So today's topic is 3 ways to invest in a bear market. Usual disclaimer, today it's very important. The information in this webinar is for educational purposes. Everything we say, all of the data that we have is historical data. Past results can never guarantee future performance. Every bear market is different. Every day in the market is different. The best we can do is learn from what's happened to try and understand what might happen in the future. As with everything, risk levels change. Always do your own research and come to your own conclusions before making any decisions. So with that said, let's talk about the goals for today's webinar. Today, March 20th of 2022, the S&P 500 dropped 20% below its high. That 20% below its high point, which happened just around New Year's, is the mark of a bear market. When the market falls 20% or more below its high, that signals the beginning of a bear market. Now, with the S&P entering or kind of just messing with the line, and by that I quite literally mean it spent the entire day almost. Thankfully, it recovered towards the afternoon, but it spent the entirety of the morning. If we look at the price, this entire period from about 11 till 3 p.m. Eastern was right at that 20% line. Again, it did recover, but it was messing around with that line quite a bit. And with that, we should start to talk about, just because we're not in the definition of a bear market doesn't mean we shouldn't prepare for how to invest in a bear market. And in a bear market, many investors, rightfully so, get a little worried. Your traditional buy and hold isn't as comfortable, and you might even return a loss. For example, for sectors, many sectors this week saw losses. So when the majority of the market is going down, you start to get worried that your investments might go down as well. So today, I want to cover 3 different ways that we can invest in a bear market. These ways have historically provided positive returns, and I'll try and provide as much information as I can to back all of this up. But note, for everyone watching it live, this should be obvious to you, but if you're watching this recorded, this webinar was prepared and given on the 20th of May, 2022. I can't promise what's going to happen for the rest of May, June, and so on. So if you're watching this 2 years in the future, you might know you will know exactly what happened, but we don't. So the best that we can do is try and prepare and understand what has happened so we can understand what might happen in the future. And I think this is the important part right here. If we enter a bear market, like a full bear market, it's never certain how long that bear market will last, and how low that bear market will go before starting its recovery. What I can tell you with certainty is this: bear markets are historically shorter than bull markets, so the bad markets are shorter than the good markets, and the market has always recovered and then some. Before we talk about that last idea a little bit more, let's cover the basics of what a bear market actually is. A bear market is a period of time in the market. We are either in a bull market, which is the market's going up, things are going up, investors are happy, and a bear market where things are going down, the majority of stocks and securities are going down, and major indexes, which is how we measure that bear or bull market, yes, are going down. The start, or the line that says bear market below here, is 20% below the high. So whenever the market goes up and then starts to go down, it creates a high point. If we go 20% below that high point, that is the line where anything below is a bear market. Now that's the start of a bear market, and like I said, bear markets don't last forever. So we eventually go back into a bull market. The end of that bull market changes depending on who you ask, but one of the most common answers is the bear market ends when all of the losses from that market have been recovered and we start to make profit again. Hopefully that makes sense. And again, I've said this multiple times already, but it's what I want to emphasize when we're talking about all of these strategies. Bear markets are typically shorter than bull markets, and by a large amount. But to show this more clearly, let's talk about some historical data. If we look at all of the bear markets that have happened in the past 100 years, the average bear market has been 1.4 years. The longest one was after the crash of 1929, aka the Great Depression. And the shortest one was in 2020. We had a bear market last the whole 33 days. Over those periods of time, the average has been 1.4 years, with an average loss of 41%. But if we ignore the Great Depression, which was huge, it's the only depression that we've had in recent American history, this average changes, where the average loss becomes 34%, and the average duration goes from 1.4 to 1 year. That's how big of an impact the Great Depression actually had on bear markets. So the average is 1 year, and the average loss is 34.4%. If that seems like a huge number, it kind of is. That we're talking about trillions of dollars here. But we got to remember, we're already down 20% right now. So this isn't another 30% from where we are. That would be another 14% from where we are. Still big losses, but it makes it all seem a little bit more reasonable, I guess. We're more than halfway down if we took the average. But again, an average is just an average. It likely could be it likely could be a smaller loss. It could be a bigger loss. We never know. Just like we don't know how long it's going to last. But let's think glass half full here for a moment. Let's talk about the good side of things. The bull markets. The markets where things are going up. Because in contrast to those bear markets, the average bull market lasts around 9 years and has an average profit of 400%. So, the good markets last longer and the profits are bigger. Like I said, historically prices go up. This is the period where they go up. So, looking at where we are right now in May, should we be worried? Should we be optimistic? How should we feel? We don't really get a choice in what's going on. We only get to decide how we invest in the market we have. But when we're looking at things long term, we shouldn't be worried. Long term, things recover. Indexes and markets recover. And the goods are bigger than the bads. And that's really what we should remember here. Now, let's go into this and talk about this whole idea of the hype. Because everyone, including me, is going to give you an idea or ideas of what to invest in a bear market. Everyone wants to capitalize on the fact that this is going on right now, that it generates a lot of clicks on YouTube, and that there's no more powerful emotion than fear. When fear drives your decision making, that's when things get scary. Now, every person, again, is going to have a different answer. And there's 5 that I really thought of when preparing this webinar. 3 are the ones that we'll discuss as more reasonable investments, and I'll talk about why I'm saying reasonable in a bit. But first, I wanted to discuss 2 that you might hear about and expose some of the bigger flaws and weaknesses in them that should provide a word of caution. Again, it's not to say these are bad, that you can't make money, but there's significantly more risk than there is the potential of reward, in my opinion. So here are those 2 types of investments. Again, even these 2 choices have ups and downs and could be profitable, but again, the risks greatly outweigh the rewards. The first one is cryptocurrencies. Cryptocurrencies have been the talk of the town for about the past almost 10 years. Bitcoin became a thing, and the first time that I was hearing about Bitcoin, it was trading for about $400 per coin. That's now about 100 times more. It's around, what is it now, 36,000? Sorry, 29,000. Bitcoin has not had a very good month. So, it's gone up about 10,000%. Everyone wants to invest in the next Bitcoin. Everyone thinks that cryptocurrencies are just this get-rich-quick scheme. You throw your money in there and you go to the moon. Everyone wants to be Bitcoin, and about the only one that's ever reached the near success of Bitcoin was Ethereum, but everyone else has struggled. And it's not just the little guys. It's not just this idea of altcoins or these small guys that you make millions in profits from. One of the largest coins total, it was number 4, I believe, on one of the major exchanges. Luna recently crashed last week, actually. And by crashed, I don't mean like the market went down 20%. I mean went down 99.89%. Billions of dollars were erased like that. Because there's no financial backing. It's not a company. There is nothing that stands behind it besides the faith of the investors, maybe a little bit of money, and what they say it can do. I'm not going to go too much into it. There's plenty of other resources online to talk about the crash of Luna, but here's what I'll say. In bear markets, many investors will pull their cash out of stocks and look to other investments to put this money into. And one of the famous terms in Wall Street Bets, which is a place online, and cryptocurrencies is buy the dip. When the price goes down, you buy that dip because now you're getting a good value and it's going to go to the moon soon. Hop on the rocket. But historically, cryptocurrencies they're not contrarian. They don't go against the market. They follow the market. So when you're looking at putting your money into crypto instead of the market because the market's going down, realize that crypto is going to follow the market more often than not. And with cryptocurrencies, unlike companies where there's the value of that company, there's nothing stopping a cryptocurrency from becoming worthless. Many have, many will, and it's not just the little guys. The big guys like Luna, it can happen to them as well. And I'm not kidding you when I say billions of dollars disappear in hours. So that's the risk there, is that one, it's not going to be an investment that will make profits when the market doesn't. It's not that crypto goes up when market goes down. There's a lot more to it than that. And two, the risk is huge because they can go to zero and there's nothing stopping them from doing that. The other one is short selling. Is there money to be made in short selling? Definitely. But let's talk about first what short selling is and, well, why I'm talking about it here. When the market goes down, the first reaction that people have is, can I make money by betting that the market will go down? Short selling is a way to do that, where instead of buying a share of stock from the market and then holding that stock, you instead borrow a share of that company and you just sell it right away. And then you hope that you can buy it back later. So you sell it first for whatever it's currently selling at, and then you hope it goes down, so when you actually have to give that share back, it's cheaper. So you're betting that the price is going to go down so that you can buy it back later at a cheaper price. Now, again, there is money to be made here, but it is so risky to short sell, even in bear markets. The single reason why, when you short sell, the most you can profit is 100%. If you buy that share for $400, you can make $400 profit if the price of that share goes to zero. If the share just disappears and it goes bankrupt. Yes, you technically just made $400. But if it goes up, there is nothing stopping it from continuing to go up. And if you sell that share at $400 and it goes up to $1,000, you have no choice. You have to buy that share for $1,000. So you lost $600. But again, this is probably not going to happen. Imagine you sell that share for $400 and it goes to $40,000. You're now on the hook for that 40 grand. So the possibilities of risk are endless, and the best you can do is 100% profit. Again, there is money to be made here, but it is some really risky money with a lot of risk. And if you don't understand exactly what you're doing, you can get burned quick. Now, let's get out of all of this kind of less good stuff, and let's cover some ways that are a little bit more quantifiable. We can explain the risk and reward a little bit better. Really, that's what we're looking for here. This is sectors made simple, not sectors made so complex that you barely know what the heck is going on. So let's keep it simple. Let's talk three ways. The first is going to be very simple. The second, a little bit more complicated. The third one, a little bit more complicated than that. But with each one, they have their pros and their cons, the goods and the bads. And I'll share both of those with you today. Method number one is dividends. Dividends are when companies release earnings and they say, all right, we made so much profit. We're going to give some of that profit back to you, the shareholder, for supporting us, for being an investor in our business. Here's a thank you. Think about it like a tip. Through good markets and bad markets, many companies, regardless of what happens to their share price, will pay out regular dividends to their investors. These dividends allow investors to have a consistent form of returns. Think about it like a paycheck. You invest in Juan de los Palotes Incorporated, and they will give you a little thank you tip every 6 months or every 4 months. And because these dividends are issued by companies, and you get access to dividends by buying shares of companies or some funds, we can use many of the same methods of investing in companies and finding companies that we already do for investing in a bull market. But now, instead of just looking at the returns of that company, we're also looking at the returns of their dividends. To explain this a little bit more clearly, let's just go into an example, shall we? The first place that I want to start is the matrix. Here at Sectors Made Simple, every day we compare all of the different market sectors of the S&P 500 to find where the bull market is. Again, bull market's an interesting term right now, but what sector holds the strength? Right now, it's energy. Energy is the leader overall. Now, what we can do with this information varies, but I'm going to show 2 ways that we can get some information from it. The first, well, really both of these, start at a website called dividendinvestor.com. Here is the link for that if you want to follow along. So on dividendinvestor.com, we can go up here to screeners and screeners and dictionaries. No, dividend detector. Sorry, I'm so used to going to stock charts and ETFDB and all of the others that say screener. Dividend All-Stars. What this is like Morningstar. They give a rating to different companies based on their dividends. It's consistency of dividends, frequency of dividends, and also, of course, how much those dividends are and how long they've been paying them. So for example, here we see a dividend yield. Let me make this a little bit bigger. We see here a dividend yield of 0.69. That means every year, Allegiant Technologies pays a dividend of, or last year they paid a dividend of 0.7% over the year, paid in 4 dividend payments. So once every 3 months, you get a little check. But what we want to do is we want to go over here to filter data. And we want to go by industry and go to energy. Now we get all of the dividend all-stars in only the energy sector. From here, the choice is up to you. You can go over to stock charts and you can look at their point and figure charts and find one that's on a point and figure buy signal. To save us a little bit of time, and because we have it, the Sectors Made Simple investment resources sheet that is available to subscribers allows us to see signals for any company we give it. So I gave it all of the companies on the dividend all-star list, all 12 companies. And we find 2 companies are currently on buy signals. ExxonMobil went on a buy signal. Okay, that's today. And the other one that we have is going to be Communits Enterprise, which went on a buy signal in, well, February. So if this is all I'm trying to do, again, I want to share the way that you can do this without a subscription, but also if you have a subscription to Sectors, how you can do it with our resources as well. So if you didn't have this, you could go through and you could individually check all of the different charts. If you have it, you can feed them all into the list and get all the signals. If I were to look at this, what I would say is this company went on a signal today. It is a high dividend payer. This would be one that I would look at. Okay, that's one selected. Show me another. Now it gets a little trickier because the rest of these, remember, we don't care just about returns. We care about dividends as well. So what we can do is go back to this list and take many of these different companies and check. We can check for fundamentals using FinViz's screener. We can check for relative strength by comparing them on stock charts. But to keep things quick, because again, I don't want to spend all day on this, we've got two other methods to talk about. What I did was I used our custom matrix on Sectors Made Simple to compare 7 of these companies. The ones that I picked were the companies that have multiple dividend payments per year and dividend rates of about 3% or more, which gives us 7 companies in total. And putting those into our list, we see that DKL has the highest strength out of all of them. They also offer a 7.4% dividend yield with 4 payments. So every 3 months, you're going to get some checks, and those checks are going to come out to be 7.4% of $52.87, or about $1 per share. That's in addition to whatever that stock price does. So no matter what, you're guaranteed about 7.4% return per year. That is not bad. That is in good markets and bad markets. Their dividend rates are going to be going up. Not going up, but are consistent. They have been doing increases. Now we're talking increases. So every period, the amount that they pay in dividends goes up. They have followed that trend for 8 years. So that is consistent. That is high dividend yield. That is a company with high relative strength in the leading sector at the moment. And we did all of that in about, if we were only focusing on that, 10 minutes, let's say. So now we have 2 choices, or honestly, you could buy, or theoretically, we could buy both. ExxonMobil, because it's currently in a buy signal and it is a dividend all-star, and EPD, based on its high relative strength and extremely high dividend yield. So that is how we would go through and find dividends. Again, it's a lot of information, but broken down just into little pieces, it's very manageable. A lot of that is things that you already would be doing to invest in stocks. Checking the technicals, checking what the price is. Is the price favorable? If it's not on a buy signal, again, we're not just buying it for what it can do for us. We're buying it because of how pretty it is. We like having a little bit of consistent return. So that is where we could get those high dividends from. Now, I just showed companies that have varying dividend payments, but here's another option. There are companies that don't just pay dividends annually or quarterly, like we just saw with ExxonMobil. There are also companies that pay dividends every single month. It's like getting your paycheck, but from a company. I went through and found some companies that, in addition to making dividend payments, what good is a dividend payment if the company is going down in value? So every company on this list is going to be profitable, where if the company goes down, the dividend payments offset that loss or are turning a profit. So let's actually look at what those companies are. We have Realty Income, which offered a dividend of 4.4%. EPR Properties, ticker symbol EPR, 6.6% dividend. LTC Properties, 6.1%. Dynex Capital, DX, 9.6% dividend. Ecofin Sustainable, which is a closed-end fund, ticker symbol TEAF, they don't use the term dividend, they use the term distribution for closed-end funds, so that is 7.4%. And again, if you don't have a Sectors Made Simple subscription, you can go through and do the normal due diligence for finding a normal stock. If you do have Sectors Made Simple, we can create a custom matrix, which I've done here, and I will share with all of you. So here we find that LTC currently holds the highest overall strength for both short-term X count and long-term positive trend. Cool. If you didn't want to just go with LTC, TEAF is in second. So that's another option for how we can find companies or funds that offer very high dividend payments to give us something in addition to just returns to look at. Now, what are the benefits and drawbacks of this method? The benefits is that it's pretty easy to understand. Again, I just talked through those examples quickly because we've got a lot to cover today. But broken down, it's very, very normal processes. Checking the price to see if the price is favorable. What benefits does that stock offer? Dividends. How many dividends per year? How much is the dividend amount? The other is that dividend payments provide consistent return. Those dividend payments will be coming in however often they say it is. And that those returns, it's just literally money in your pocket, or you can reinvest those dividends back into the company. And that offsets some risk of losses. So if the stock price goes down, but you made more in dividends than the stock price lost, you still come out ahead. But if the company goes up, remember, bear markets always recover. When that recovery happens, if you're holding a stock that offers dividends, you make profit on the company, and you always make profit on dividends. So you double up your returns there. Again, dividendinvestor.com, they do have a little bit of a paywall. There is some limits to what you can search with the free account, but it's enough to get you going. And looking up a normal company, just a single company, they give you everything you need to know. So that is the pros of method number 1. The drawbacks is that individual companies are still just that, individual companies. Those companies can change price much faster than broader markets, sectors, or even industries can. One company could have really bad earnings, Target, I'm looking at you, and drop 25% in a day. Likely that's not going to happen. It is very rare to see that happen. But again, when we're looking at risk of an investment, the fact that it is not diversified, it is a single company, is a factor of risk. And then the second one is that not all companies issue frequent dividends or even increasing dividends. So if you buy a company that only offers one dividend per year and they paid that dividend last month, you're going to be holding for 11 months before you get your next dividend payment. So looking at when the last time they paid dividends is very important. It will be the difference between you holding for 11 months or 11 days until your next dividend payment. Does anyone have any questions about what we've talked about so far? If so, please put them in the chat. Again, this is a live stream. If you're watching this live, I'm more than happy to go through and answer those questions. In the meantime, we're going to get started talking about method number 2, which is inverse ETFs. Exchange traded funds are not a new topic here at Sectors Made Simple. But inverse ETFs are something that are a little bit less talked about. Oh, is there any hidden fees? So you're just buying a normal company. So there is no hidden fees. Closed-end funds will have an expense ratio. So those are like any other ETF. They will have an expense ratio. But for the normal companies, there's no expense ratio. There's no maintenance fee or anything like that. So inverse ETFs are where things get a little interesting. Again, we're talking here about strategies that apply to when the market's going down. If the market's going down, instead of trying to find the fish that's fighting the current, what if we could just profit by going with the current and betting against the market? What if we could make money by saying that the market's going to lose money? That's what inverse ETFs do for us. They work very similar to a normal ETF. They invest in securities, stocks, bonds, whatever they invest in, and they track the performance of an underlying an underlying index. So they might track the S&P 500, the Russell, they track many different indices. But instead of a normal ETF, where you make profit when that index goes up, here, in an inverse ETF, you make profit when that index goes down. Within inverse ETFs, though, we still have a little bit of choice. Namely, we can change how much risk we have. So we can say, let's take more risk, but also more reward. Or let's take less risk, but less reward. To use the investing term and the term that you'll always see when talking about these, we talk about leverage. So we're going to talk now about leveraged ETFs, but more importantly, inverse leveraged ETFs. So leveraged ETFs go a step further than just being a normal fund. They increase the risk and reward from an index by a certain amount. It's not guaranteed, it's not perfect, but just like an ETF tries to track an index, a leveraged fund will try and follow that index with that leverage included. For today, we're going to keep things simple. We're not going to get crazy. We're only going to focus on inverse leveraged ETFs. So all of these ETFs make money when the market goes down. Let's use an example. If we have what's called an ultra short ETF, that means that it is short, so it makes money when the market goes down. And ultra typically refers to a 3 times leverage. What minus 3x means is just this. If the market goes down by 1%, or if the index that it follows goes down by 1%, our ETF should go up by 3%. Remember, 3x. So down 1% is up 3%. Down 2% is up 6%. But the same thing is true for losses. If the market goes up by 1%, we go down by 3%. So now, again, ETFs are not a new idea. The idea of buying a fund is not a new idea. But how do we find this information? How do I choose an inverse ETF to invest in? The easiest way that I've found is using etfdb.com that just this week became Vetify. But on etf.com, we can use their screener. So if we go up here to Tools, ETF Screener, and we zoom in, we can go down here and we can go to Equity to say that we want to trade stock, and then scroll down to Attributes. And here we set our 2 things. One is we want inverse. So now all of these ETFs will make money when the market loses money. The other thing that we can set is our leverage. We can have just normal 1x leverage, we can have 2x, and we could have 3x. So if we look here, we can go over and we can sort. We can find SPDN. This is the 1x. This is just supposed to be the inverse of SPY. So while the market has gone down by close to 19%, SPDN has gone up by almost 19%. So if you want to just bet against the market, but you don't want to expose yourself to crazy risk and reward, SPDN is the inverse of the S&P 500, where when the S&P goes down, this goes up. Again, this is the easiest way to find that list, but the list is not very big. We're still looking here at, on ETFDB, 63 ETFs. On ETF.com's screener, we get 71 inverse ETFs. So that list is pretty short. Another place that we can find information is going to be finviz.com with their map function. So I will send you all the link for that in one moment. So here is the Finviz screener map, or sorry, the Finviz map, where it shows us the entire market. Oh my goodness, so many ads. It shows us the entire market and where things are making and losing money. It should be no surprise that the market right now in the past month is losing money almost everywhere, except for energy, volatility, and inverse, leveraged energy, and oil, which is also an energy. Inverse is king though. Go figure. The market's going down. The people that are making money are the ones that are shorting the market. But if you're going to use this, and again, this is a really nice resource because you can sort by 1 day performance, 1 week performance, 3-month performance, year to date. I do want to say one thing. Yes, we just talked about where the benefits are, or where the bull markets are right now. Be careful. Be careful if you're going to use this map, because the size of those boxes, unlike if you just look at companies, which will show you how big that company is, what the market cap of that company is, on the ETFs map, it shows the return in dollars of those different funds. Because leveraged ETFs will have magnified returns, 2x or 3x returns, they will be the bigger boxes. Don't look at 30% and say, wow, I can make 30% here. It's great. It's free money. It's free money when the market's going in that direction, but it's much higher risk when the market turns around. Again, bear markets don't last forever. You can't just bet that it's going to continue going down and down and down like you can in a bull market, thinking that things are going to go up and up and up. So now, what are the pros and cons here? The pros, unlike dividends that require you to be invested when those dividends are recorded, there's what's called the dividend X date or EX date, and then the day after that is the recording date. The recording date is when they write down everyone's name on a list. They don't bother checking it twice. But if you're on that list, congratulations, you get a nice check. If you buy in after that date, you're waiting until the next dividend payment. So if you're buying a company not because of the price, but because of dividends, you care about when those dividend payments are. So that's going to affect what you buy today if the next time those dividends are paid is 2023. With an inverse ETF, you can buy any time. You can buy, well, of course, only when the market's open. You can buy today, not today. You can buy Monday. You can buy next Friday. You can buy the following Tuesday. Markets close that Monday. So you can buy them anytime like you would any other security. And with the fact that there are leveraged ETFs, you can choose your own risk and reward. you can choose that you want to take a 3x leveraged ETF. So when the market goes down 1%, you go up 3%. If you don't want that risk, you can go with just the normal 1x or minus 1x, where when the market goes down by 1%, you go up by 1%. So that's the benefits. You're not worried about when the dividend payments are or how many of them there are or how often they pay them. All you care about is the price. The drawbacks? Well, now we're talking about funds. Funds carry expense ratios. They charge you something to do all of this work. Unlike an index fund that will just, many of them are passively managed. They don't need to do much. So the expense ratio on those is very small, usually 0.09, some will even be 0.03, maybe up to like 0.15. With inverse ETFs, it goes up a lot. For example, SPDN is about a 0.45% expense ratio. So if you invest 100% of your money, they will take almost 0.5% just for saying, you invested your money with us, thank you. This is what we take as our cut. Okay, that stings a little bit. If you want to go with a leveraged inverse ETF, it's about 1%. So about 1% of your money that you put into this fund is just going to get taken out as fees. The rest gets invested. So that is significantly larger than a normal index fund that is bullish. So be aware, if you're looking at these, that for that privilege of getting into something that they invest for you, you are running the risk, or you're running a higher expense ratio than if you were just investing in a long ETF. Also, like I said before, your options are much smaller when it comes to ETFs or funds in general that are inverse. It's a lot more work, and there's a lot fewer of them. And because there's a lot fewer of them, you're not going to find those super niche semiconductor inverse ETFs. No, none of that. We get broader exchanges, or we get broader indexes. S&P 500. That's about as detailed as you'll probably get. Maybe a few sectors have inverse ETFs. But when you have less than 100 to start from, and you're trying to compare prices, you don't have a lot of choices to go with. Now, option number 3 is, like I just said the word, options. These are the final choice for us, but are also the most complex. I will say this right now because if you end up clicking off the video, I do want you to remember this. Options are complicated, they are challenging to learn, and if you don't know what you're doing, you open yourself up to a lot of risk. Now, while dividends offer a choice for long-term investors and mid-term investing to a certain extent, options are a little bit more of a choose-your-own-adventure. There are ultra short-term options or immediate-term options. There are weekly, monthly, quarterly, and yearly options. So there's a lot of choices that you can have when it comes to buying an option or investing in options. But before we go any further and talk about why options, let's first answer what are options. Options, much like the name says, is an option where it gives you the right but never the obligation to trade shares of a company at a given price. That means that you can choose whether or not to use that option or not. Options will always have these. What they're trading. So what stock is that option for? What direction is it? Is it an option to buy, which is a call, or as an option to sell, which is a put. The strike price. This is the option, or this is the price that if you choose to use that option, that you can trade that stock at. Expiration, which is how long that option is for. And then premium. What do you pay for that option? Kike, how about daily options? Is there anything like that for SPY? There are options for SPY that expire every Monday, Wednesday, and Friday. This is a Spanish chat channel. We have a very large Hispanic audience where all of our website and all of our services are translated into Spanish. We do have many webinars that are in Spanish, but all of the webinars that I do, which is every Tuesday I do a members webinar and every Friday I do a free webinar, is all in English. And for all of our Spanish webinars, we have translations to English, or subtitles in English available as well. So let's go through now and talk about an example of an option. SPY 390, 527 call at 553. That's a lot of stuff. Let's break it down. The option is a choice to buy, because it's a call, SPY, which is what it's for. The price is at $390 per share on or before 527.22. And the option costs $5.93 per share. An options contract is always, or 99.999% of the time, 100 shares. So if I wanted to buy this option, it would cost me $593. Now, that's great, but how does this actually turn into, returns? Well, once we actually own an option, it will end in one of three ways. One and two, is that the option is profitable. It's in the money. That means if you take that option and you choose to exercise it, you'd buy or sell those shares, depending on if it's a call or a put, for a price that is better than it's currently traded at. So if we had a buy option for $380 and SPY is around $390, that means that we would buy the shares for $380 and instantly we could sell them for $390, making $10 profit per share. But that's a lot of money because you would need to buy 100 shares. So that's almost $39,000 that you got to have sitting around. If you don't want to exercise that option yourself, you can sell that option to someone else and let them deal with it. But because the option's value has gone up, it's now an in-the-money option. You're going to probably get more than what you paid for it. So if we were now looking, instead of a $390 strike price, we were looking at $380, the price of that option is $12.75. In-the-money options are always going to be profitable. That's why they're called in the money. Now, the possibilities for profit with options is huge because it allows an investor to trade shares for guaranteed profit. If you can buy a share right now and immediately sell it for more, of course, that's going to have value. The value is going to go up the more profitable it is. But also there's always value in what it could be. But that what it could be is also the largest risk. According to CBOE, about 55 to 60% of options expire worthless. They go the way of the cryptocurrencies or Cinderella's carriage. Turns into a pumpkin. That means if we invested that $593 into SPY calls and SPY's price goes down, why would you exercise that option and lose money? You're not going to. So you let the clock strike midnight or you let the market close and your $593 turns to zero. You could also sell your option. But again, the closer to expiration, the closer to zero it's going to be. And the further out of the money it is, the lower it's going to be worth. And everything we've talked about so far is only talking about one direction. Buying calls. Going up. Literally Luna. Yeah, Luna's been an interesting one to watch. So everything we've talked about are long positions for buys. But you can also purchase an option to sell, or puts, where you're betting that the thing is going to go down. So you can bet going up, you can bet going down, you can bet short term, you can also bet long term. And this isn't just for SPY. This is for any company. You can buy, or most companies, you can buy puts and calls for them. So if you think it's going to go up, you can buy a call, and if it goes up, you make profit. If it goes down, it can expire worthless, or if you sell it early, you would lose money. If you think it's going to go down, you can buy a put where you would make money if it goes down. It could expire worthless if it goes up. So now, the pros and cons of method 3, options. The first one is the most obvious. We're talking high risk, high reward here. And because you can bet not only on what direction you think it's going to go, but how much you think it's going to change, if you know what you're doing, there is a lot of room for profit. Also, you can invest short term, where you can invest in options that expire this week or even today. You can also invest in weekly options, monthly options, so on. So you can choose what time horizon you want to work with. If you're trading actively, you can invest in those daily options. If you're the kind of person that just wants to check it every so often, maybe monthly. The choices are up to you. Now, the drawbacks. And I want you to remember the drawbacks more than you remember the benefits. Investing with options can be very confusing. There is not the one price that you have for that stock. There's no bid-ask spread for the stock. There is an entire options chain where every single option with a different strike price and a different expiration has a different buy-ask spread. It's crazy. And if you don't know what you're doing, there is a lot of risk. Because while it is common, if you're investing in options, to have days of 60 or even 100% return, with every single investment, you run the risk of losing all of it. If that option expires worthless, and you're stuck holding that option, it's now worth zero. And that's not just, there is one chance, it's every option, if it expires out of the money, is worth $0. So if all of this is a little frightening, again, we've talked about 2 other methods. But if options is something that's interesting, we're here to help. Yes, this is Sectors Made Simple, and we focus on sector rotation, but Julie Stav, my mother, is also offering options workshops. These workshops are included in the price of a Sectors Made Simple annual subscription, are hosted twice a month live on Zoom, and in these series, she covers the fundamentals of trading options. What options are, how we can use technical analysis to find entry and exit points for options, and all of this comes with a paper trading portfolio so that you can put your figurative money where your literal mouth is and learn how to use options the real way, doing it. The best way to learn is doing it, but again, there is high risk. So learning, understanding, and making profit or even loss. Everyone always says you learn more from your defeats than you do your victories. We're using paper trading so that we can learn from those losses, and if an option expires worthless, you reset your portfolio to $100,000 and we start again. Don't worry. Restarts are allowed. So, if you made it to the end of this webinar, I hope this has given you a little bit more comfort in the current situation of the market. Bear markets are temporary. Bull markets last longer than bear markets. The market always recovers. But in the meantime, here are three options that we have, or three methods that we have that we can invest with in a bear market to still see profit. If you've enjoyed this webinar, please give it a thumbs up. It makes me happy, but more importantly, it makes the algorithm happy, and we all need to please the algorithm a little bit. And it's also free. So please give it a thumbs up if you enjoyed it. And if you really enjoyed it and want to see more of our content, we do these webinars every Friday, live on YouTube at 4 p.m. Pacific, 7 p.m. Eastern Time. And a great way to get reminded is to hit that subscribe button on YouTube. Again, totally free, and it makes me happy. So, thank you all so much for joining us today. If you have any questions, you can always email us at support@sectorsmadesimple.com, and we'll see you all back next week for another webinar. Thank you all so much. Take care.